$130 silver in Tokyo. It just happened. Verified. $50 spread exposed $130 silver in Tokyo, while New York traded at $80, a $50 spread. In a market that's supposed to be global, this isn't a glitch. It's verified. Major institutions are moving quietly. Industrial buyers are panic purchasing, and the paper markets, they're pretending nothing happened. But here's what they're not telling anyone. The last time a precious metal showed this kind of regional dislocation, 3 major banks collapsed within 90 days. What happened in Tokyo last week isn't staying in Tokyo. Welcome to Financial Inspection. Now, if you've been watching markets long enough to remember when a handshake meant something, when contracts were honored, and when prices actually reflected reality, then you know this isn't normal. Do us a favor, would you? Hit that subscribe button down below, the red one. Can't miss it. We need folks like you here, the ones who remember what real markets look like. And while you're at it, drop a comment and tell us, where in the world are you watching this from? London, Mumbai, Sao Paulo, New York? Because what's happening isn't local anymore. It's everywhere. Let's begin. On the morning of December 18th, 2024, something unusual happened in Tokyo. Silver, a metal that typically trades within a few dollars of the same price worldwide, suddenly hit $130 per ounce on Japanese exchanges. At that exact moment, New York showed $80, London showed $82, Shanghai reported $81, a $50 difference. In a market connected by instant communication, by algorithmic trading systems, by traders who exploit even 10-cent differences for profit. This wasn't supposed to be possible, yet multiple sources confirmed it. Reuters verified the pricing. Bloomberg terminals displayed the numbers. Japanese bullion dealers reported the transactions. This wasn't a data error. This wasn't a typo on a screen. Real buyers paid $130 per ounce in physical silver in Tokyo. And the financial world barely noticed, but a few people did notice. Veteran traders with decades of experience in commodity markets saw the numbers and immediately understood what they meant. Industrial procurement officers and electronics companies saw their cost projections shatter overnight. Analysts at precious metal refineries watched the data and quietly began making phone calls, because they remembered what happened before. In 1980, silver showed unusual regional pricing anomalies weeks before a dramatic price spike. In 2008, platinum exhibited strange geographic spreads months before a supply crisis. In 2020, palladium had similar warning signs before prices doubled. Every single time, the regional price dislocation came first. The global price explosion came later. So what caused Tokyo to break away from global silver prices? The immediate explanation seemed simple enough. Japan is a major industrial consumer of silver. The country's electronics sector uses massive quantities. Solar panel manufacturing requires steady silver supplies. Automotive applications demand consistent delivery. When someone examined the actual supply situation in Japan, the picture became concerning. Refineries reported delivery delays of 4 to 6 weeks. Normally, they delivered within 10 days. Bullion dealers described clients willing to pay any premium for immediate possession. Industrial users mentioned difficulty securing long-term supply contracts. These weren't anecdotes from unreliable sources. These were statements from established firms with decades of operational history. The Tokyo Commodity Exchange showed something else. Physical inventory levels had declined by 43% over the previous 6 months, not gradually, but in sharp drops during specific weeks. Each drop corresponded with major industrial contract renewals. Someone was buying everything available, and they weren't selling it back. This created a fundamental problem. In normal markets, arbitrage prevents large price differences. If Tokyo trades at $130 and New York trades at $80, someone should immediately buy in New York, ship to Tokyo, and pocket a $40 profit per ounce. Minus shipping costs, insurance, and handling, they would still clear $35 per ounce. At scale, that's enormous profit. So why wasn't it happening? The answer revealed something deeper. Several major shipping companies reported unusual delays in precious metal transport to Asia. Not catastrophic delays, just enough friction to slow the arbitrage process. Insurance costs for silver shipments had increased by 60% in 3 months. Some refineries mentioned they were prioritizing long-term contract customers over spot market buyers. Each factor alone seemed minor. Together, they created a barrier to the normal flow of silver from west to east. But there was something else, something the official explanations didn't quite address. If this was purely a Japanese supply issue, why weren't other Asian markets showing similar premiums? Hong Kong had strong physical silver markets. Singapore served as a major precious metal trading hub. Neither showed anything close to Tokyo's pricing. This suggested the issue wasn't simply Asian demand, it was something specific to Japan. Currency analysts pointed to the yen. Japan's currency had experienced significant volatility throughout 2024. Import costs had risen substantially. Perhaps Japanese buyers were simply paying more in yen terms, and the conversion created the appearance of a premium. But the calculations didn't support that theory. Even accounting for currency fluctuations, the spread remained inexplicably large. A small group of analysts began examining a different possibility. What if Tokyo's price wasn't the anomaly? What if Tokyo's price was correct, and everywhere else was wrong? What if the 80 unpolar silver price in Western markets didn't reflect the true cost of obtaining physical metal, but merely reflected the price of paper contracts that promised future delivery? That question changed everything. Because, if true, it meant the global silver market wasn't functioning as a unified whole. It meant price discovery had fractured. It meant the numbers everyone relied on weren't real. And it meant Tokyo was simply the first place where reality broke through. 3 weeks before the Tokyo price spike, a procurement manager at Panasonic sent an internal memo that never made headlines. The memo was brief, clinical, almost boring in its technical language. It stated that silver delivery schedules for Q1 2025 could not be guaranteed. For a company that had received uninterrupted silver supplies for 47 years, this was extraordinary. But nobody outside the company knew about it. 2 days after that memo, a similar message circulated inside Sony's supply chain division, then Toshiba, then Mitsubishi Electric. Each message used different words, but the core problem remained identical. Physical silver wasn't arriving on schedule. These weren't small companies experimenting with new suppliers. These were industrial giants with decades-old relationships with the world's largest refineries. They had contracts, they had payment histories, they had priority status, and still, the silver wasn't coming. When investigators began tracing the problem backward through the supply chain, they found something peculiar. The issue wasn't at the mines. Global silver mining production in 2024 remained relatively stable. Mexico continued producing. Peru maintained output levels. China's mines operated normally. The problem appeared somewhere between extraction and delivery. Refineries became the focal point of scrutiny. A refinery transforms raw silver ore into pure metal bars, meeting industrial specifications. This process operates on tight schedules. Ore arrives, processing occurs, finished bars ship out. The entire cycle typically takes 2 to 3 weeks. In late 2024, that cycle stretched to 6 weeks, then 8, then 12. Refinery representatives offered various explanations: labor shortages, equipment maintenance, regulatory compliance updates, energy cost considerations. Each explanation sounded reasonable individually, but when someone mapped all the delayed refineries on a single chart, a pattern emerged. Every major refinery serving Asian markets showed identical delays. Refineries serving European markets, operating normally. Refineries serving North American markets, slight delays, nothing severe. Refineries with contracts to deliver to Japan, South Korea, and Taiwan, systematic backlogs. This wasn't coincidence, this was structure. One commodities analyst in Singapore spent 3 weeks investigating what he called the refinery mystery. He contacted operations managers directly. He reviewed shipping manifests. He examined warehouse receipts from 3 continents. His conclusion arrived in a 40-page private report, shared only with select clients. The refineries weren't slow. They were being instructed to prioritize certain customers over others. And Asian industrial buyers had dropped to the bottom of the priority list. Who occupied the top of that list? The analyst's report identified 3 categories. First, long-term government contracts with sovereign entities. Second, major financial institutions with allocated storage agreements. Third, strategic industrial partners in Western markets with military or defense applications. Everyone else waited. Japanese manufacturers, despite being among the world's largest silver consumers, found themselves competing for whatever remained after those priority allocations filled. This explained why the Tokyo price spiked, while Western prices stayed subdued. In Tokyo, buyers competed for genuinely scarce physical metal. In New York and London, traders exchanged contracts representing silver that might not actually exist in available form. But the supply disruption contained another layer. Transportation companies reported unusual patterns in silver shipment routing. Normally, silver moves from refineries to regional distribution hubs, then to end users. One shipping logistics coordinator in Rotterdam described receiving instructions to reroute a container originally destined for Osaka. The new destination, a private facility in Zurich. The client paid triple the normal handling fee for immediate delivery and discrete processing. That coordinator handled 4 more identical reroutes within 30 days. But silver markets operate on thin margins. Industrial users maintain minimal inventories. Refineries hold limited buffer stocks. The entire system depends on continuous flow. Remove 2% from circulation, and certain regions face immediate shortages. Japan was that region. The country's industrial base required steady silver inputs. Solar panel manufacturing alone consumed substantial quantities. When supplies tightened, manufacturers couldn't simply reduce production. They had contracts to fulfill, revenue projections to meet, shareholder expectations to satisfy. So they did what desperate buyers always do. They paid whatever price secured the metal. And when word spread that buyers in Tokyo would pay $130 per ounce, something shifted. Smaller holders, individual investors, small dealers, independent traders began moving silver toward Japan, not through official channels, not through established refineries, through private arrangements, direct sales, and informal networks. This created a secondary market, one that operated outside traditional pricing mechanisms, one where physical possession mattered more than paper contracts, one where Tokyo's $130 price wasn't actually high enough. Because the whispers in private dealer networks suggested something darker. Some buyers in Japan weren't paying $130. They were paying $150. They just weren't advertising it. And if that was true, then everything the public knew about silver prices was fiction. The real market had moved underground. On a Tuesday afternoon in November, a derivatives trader in Chicago made a decision that should have been impossible. He sold 17,000 ounces of silver. Silver he didn't own. Silver he had no intention of ever owning. Silver that, for all practical purposes, didn't exist. The transaction took 4 seconds. His screen flashed green. The order filled, his position registered in the COMEX system. And somewhere in the global financial network, a buyer now believed they owned 17,000 ounces of silver. Except they didn't. They owned a promise, a contract, a legal agreement that said if they wanted physical silver on a specific future date, someone would deliver it. But here's what made that Tuesday afternoon noteworthy. That same trader repeated the transaction 93 times that day. He wasn't alone. Across the COMEX silver futures market, hundreds of traders executed similar transactions. Each sold silver they didn't possess. Each created new contracts representing metal that existed only in digital ledgers. By the end of that trading day, the COMEX system showed open interest representing 1.2 billion ounces of silver. Total global annual mine production, 800 million ounces. Total physical silver available in COMEX warehouses, 67 million ounces. The mathematics revealed something unsettling. For every physical ounce available for actual delivery, 18 contracts existed claiming ownership of that same ounce. This wasn't illegal. This was standard market practice. This was how commodity futures markets operated. And this was why Tokyo's price made perfect sense. Because in Tokyo, buyers weren't purchasing contracts. They weren't trading promises. They weren't speculating on future delivery dates. They were demanding immediate physical possession. And when someone demands something real in a market built on abstractions, the abstraction shatters. A retired commodities analyst in London, someone who spent 40 years studying precious metals, reviewed the Tokyo situation and wrote something in his private newsletter that received little attention. He wrote, "The paper market has finally encountered physics." His point was simple but profound. Paper contracts can multiply infinitely. Creating a new futures contract requires nothing more than two parties agreeing to terms. No metal needs to change hands. No warehouse needs additional storage. No refinery needs increased production. But physical metal obeys different rules. It exists in finite quantities. It occupies physical space. It requires mining, refining, transporting, and storing. It cannot be created by algorithmic trading systems or financial engineering. For decades, these two markets, paper and physical, coexisted peacefully. The paper market provided price discovery and liquidity. The physical market handled actual industrial supply. Traders understood the distinction. Industrial users knew when to enter physical markets versus when to hedge with futures. The system functioned because everyone trusted the paper contracts remained convertible to physical metal if necessary. Tokyo destroyed that trust. When Japanese buyers demanded physical silver and discovered they couldn't obtain it at paper market prices, they learned a dangerous lesson. The price on their screens didn't represent reality. One silver dealer in Osaka described the shift in client behavior. Before December, institutional clients routinely purchased futures contracts for price exposure. After December, those same clients requested physical bars with immediate delivery. No futures, no contracts, no promises, metal in hand, or no transaction. This behavioral change spread through financial networks like a virus. Investment funds holding silver ETFs began examining the fund prospectuses more carefully. They discovered language permitting the fund to settle redemptions in cash rather than metal under certain circumstances. That language had always existed. Nobody paid attention before. After Tokyo, everyone noticed. Several large institutional investors submitted redemption requests specifically demanding physical delivery. The ETF administrators faced a choice: deliver actual metal from their vaults or negotiate cash settlements. Most negotiated cash settlements. This confirmed what the skeptics suspected. Even the funds that claimed full physical backing didn't actually hold enough metal to satisfy simultaneous redemption demands. They operated, like the COMEX, on the assumption that not everyone would request physical delivery at once. Tokyo proved that assumption wrong. A game theory specialist at a Swiss bank modeled what would happen if just 15% of global paper silver holders simultaneously demanded physical conversion. His model crashed on the third iteration. The system contained no mechanism to handle that scenario, because the system never anticipated people would stop believing in paper. But belief was eroding faster than institutions acknowledged. One particular incident accelerated that erosion. A hedge fund in Singapore held substantial silver futures positions through a major broker. In early January, they decided to stand for delivery. This meant converting their futures contracts into physical metal. Standing for delivery was rare, but not unheard of. The process had clear procedures. The fund submitted proper documentation. They paid all required fees. They arranged vault storage, then they waited. Delivery was scheduled for January 15th. January 15th passed. No silver arrived. The broker explained there were logistical complications. They offered to settle in cash at the current market price, plus a small premium. The fund refused. They wanted the metal. January 22nd arrived. Still no silver. The broker offered a larger cash settlement, double the original premium. The fund refused again. They informed the broker they would file formal complaints with regulators if delivery didn't occur within 48 hours. 36 hours later, the silver arrived. Not from a COMEX warehouse. From a private vault in London that wasn't part of the official delivery system. The fund received their metal, but the incident raised uncomfortable questions. If the exchange system couldn't deliver silver on schedule to a large institutional client with proper documentation, what happened to smaller buyers without legal resources? How many others received cash settlements because they lacked the power to demand actual metal? And most critically, if the warehouses held sufficient silver to back all contracts, why did the broker need to source metal from outside the system? The answer arrived through whispered conversations in dealer networks. The COMEX warehouses weren't empty, but they weren't full either. Most silver in those warehouses belonged to specific owners with allocated storage. That metal wasn't available for delivery to futures contract holders. The silver available for delivery, the unallocated inventory that backed the massive futures market, represented a fraction of total warehouse holdings, perhaps 20%, perhaps less. Nobody knew exact figures because the reporting systems didn't distinguish between allocated and available inventory in public disclosures. Tokyo's $130 price wasn't an anomaly. It was honesty. It was the price required to extract physical metal from a system designed to discourage physical delivery. And now that honesty was spreading, Hong Kong dealers reported premiums increasing. Singapore saw similar movements. Even London, the traditional center of global precious metals trading, experienced unusual spreads between paper and physical prices. The illusion was fracturing, not catastrophically, not suddenly, but steadily, inevitably, like ice cracking under weight. And once enough, people stopped believing in paper. The real price discovery would begin. A manufacturing executive in Stuttgart received an email on January 8th that changed his entire strategic planning for 2025. The email came from his company's primary silver supplier. It contained one sentence: "We can no longer guarantee delivery timelines specified in existing contracts." This executive managed production for a mid-sized electronics firm. His company wasn't a household name, but it supplied critical components to major automotive manufacturers. Silver formed an essential input in their process. Without silver, production stopped. Without production, contracts failed. Without fulfilled contracts, the company faced penalties, lost revenue, and potential bankruptcy. He had three choices: accept delayed deliveries and hope production schedules absorbed the impact, find alternative suppliers willing to honor timelines, or secure physical inventory immediately, regardless of cost. He chose the third option. Within 48 hours, he purchased 6 months of silver inventory at prices 30% above his budgeted costs. His CFO questioned the decision. His board expressed concern about capital allocation. He showed them the Tokyo pricing data. The question stopped, because he understood something many others hadn't yet grasped. The businesses that survived the next phase would be those who secured physical resources before the market fully repriced. This wasn't speculation. This was survival. Across global industries, similar calculations were occurring. Supply chain managers at solar panel manufacturers reviewed inventory positions. Procurement officers at electronics companies renegotiated contracts. Production planners at automotive firms built larger material buffers. Each decision, individually, seemed prudent but unremarkable. Collectively, these decisions created a new problem, When everyone simultaneously attempts to increase inventory, they generate demand that supply chains cannot satisfy. This triggers a feedback loop. Perceived scarcity creates actual scarcity. Actual scarcity validates the perception, and prices accelerate beyond rational modeling, but the implications extended far beyond silver markets. Financial analysts began examining other commodities for similar paper-physical divergences. Platinum showed early warning signs. Palladium exhibited unusual geographic pricing variations. Even copper, a metal with far larger and more liquid markets, displayed subtle anomalies in regional premiums. The Tokyo silver event wasn't isolated, it was symptomatic. It revealed structural fragility in how modern commodity markets functioned. For decades, financialization of commodity markets created efficiency and liquidity. Futures contracts allowed producers to hedge risk. Derivatives enabled sophisticated price discovery. Electronic trading reduced transaction costs. But financialization carried a hidden cost. It divorced price from physical reality. As long as everyone believed paper and physical remained interchangeable, the system functioned. But belief, once questioned, proves difficult to restore. And Tokyo questioned everything. Portfolio managers at investment funds faced uncomfortable decisions. Many held substantial positions in precious metal ETFs. These positions appeared on balance sheets as physical metal exposure. But after Tokyo, some managers began asking harder questions. Could their ETF actually deliver physical metal if requested? What percentage of the fund consisted of futures contracts versus actual bars? If multiple large holders requested redemption simultaneously, would the fund have sufficient physical inventory? The prospectuses contained answers, but the answers weren't reassuring. Most ETFs reserved the right to settle redemptions in cash under certain conditions. The conditions weren't clearly defined. The decision rested with fund administrators. This meant ETF holders didn't truly own metal. They owned a financial product that tracked metal prices under normal conditions, but might not provide metal access during stress periods, precisely when they would need it most. Some sophisticated investors began shifting allocations, not dramatically, not publicly, but steadily they moved from paper exposure to physical possession. This created its own cascade effect. As paper markets saw reduced participation from major holders, liquidity declined. Reduced liquidity meant larger price swings from smaller trades. Larger price swings attracted algorithmic trading systems designed to exploit volatility. The algorithms didn't distinguish between fundamental moves and technical noise. They simply amplified whatever direction prices moved. This created conditions where a relatively minor physical shortage in one region could trigger disproportionate price movements globally. The system had become unstable, but instability alone wasn't the primary concern. The real issue was information asymmetry. Large institutions with resources to conduct deep supply chain analysis understood the physical market situation. They saw the refinery delays. They tracked the warehouse inventory declines. They noticed the geographic pricing anomalies. Smaller participants lacked those resources. They relied on publicly reported prices and official inventory figures. They believed the market remained orderly and liquid. They were wrong. This created a dangerous dynamic. Informed participants positioned themselves ahead of price moves. Uninformed participants entered markets unaware of underlying structural problems. When repricing occurred, the uninformed bore the losses. This wasn't theoretical. Several small investment funds holding silver positions through futures contracts discovered in early January that their broker had closed their positions without authorization. The broker cited risk management protocols and market volatility concerns. Those funds intended to stand for physical delivery. They never got the opportunity. Their positions were liquidated at paper market prices. Days later, physical silver prices in Asian markets rose another 15%. The funds had no recourse. The contracts permitted broker discretion during extraordinary market conditions. Who defined extraordinary? The brokers. This wasn't isolated to small funds. Mid-sized institutional investors reported similar experiences. Positions closed unexpectedly. Delivery requests denied. Cash settlements forced through. The paper market was protecting itself by preventing physical conversion. Meanwhile, a different class of participants operated with different rules. Sovereign wealth funds experienced no difficulty obtaining physical delivery. Major banking institutions secured metal without delays. Government entities faced no broker intervention. The system had stratified. Those with power and connections accessed physical markets freely. Everyone else received paper and promises. This bifurcation signaled something deeper than a commodity supply issue. It revealed the architecture of modern financial markets. When stress emerged, the system prioritized certain participants over others, not based on market principles or price mechanisms, based on institutional relationships and political considerations. Tokyo's $130 silver price wasn't an endpoint. It was a beginning. It demonstrated that physical scarcity could override paper market pricing. It proved that regional markets could disconnect from global benchmarks. It showed that delivery promises held less value than physical possession. For business leaders, the implications were clear. Supply chains depended on commodities with significant futures. Market activity carried hidden risks. Those futures markets might not provide reliable price signals during stress. They might not deliver physical material when needed. Companies with just-in-time inventory strategies faced particular vulnerability. The competitive advantage was shifting toward those who controlled physical resources, toward those who understood the difference between paper and reality, toward those who positioned themselves before the crowd recognized what was happening. The Tokyo event provided a roadmap. Watch for geographic price divergences, monitor physical delivery timelines, track warehouse inventory trends, observe institutional behavior changes. These indicators wouldn't prevent market disruptions, but they would provide warning. Enough warning to act while options remained available, because the next phase was approaching. The phase where paper markets either restored credibility through actual physical delivery or collapsed under the weight of promises they couldn't fulfill. Tokyo was the warning shot. What came next would determine whether anyone had listened.